We'll start. Hi everyone, my name's Kathy Constant and I'm the CEO of Logix and I'm also a board member of ALTA. I'm the Sponsorship and Events Director and I'm very pleased to be hosting today's member meetup, which is based on funding and financial management for legal tech. And joining me today in this discussion is Harley Beaumont. So Harley Harley and I have had a little bit of a chat beforehand, so I must tell you that it was quite an interesting conversation. And to tell you a little bit about Harley, he first joined Macquarie Bank in 2010, and he spent the last 12 years in the business and commercial banking division. In addition to the team focus on debt funding of commercial property, the division also specialises in cash flow, secure lending capability across a range of professional services industry, totaling in excess of $14 billion. Harvey is currently responsible for the Victorian built environment, technology, health and education segments of the business. He's a specialist and is focusing on providing acquisition finance, growth capital and succession planning to these professionals. So Harley is a really key person in that banking state for that funding that startups would be looking to sort of access. So anyway, turning over to you, Harley, say a little bit about yourself and where Macquarie sits in this whole space and what we hope to achieve in this Q&A today.
Kathy, thanks very much, and it's a real pleasure to be representing Macquarie today with ALTA. It's been a good partnership now over a number of years. So this kind of opportunity to collaborate is fantastic, and hopefully we can bring some value through the conversation or potentially subsequently as well. So again, very much thank you for your time and great to meet all the members who are here today. Apologies just throwing as well, my colleague Adib Bar is here also, who's in our team with a specialist technology banking focus, and I think it's a good opportunity today to talk about some of the various capital raising options for technology businesses, and where Macquarie sits is quite interesting. But I think it's across the entire vertical really of technology space, and what's happened in recent years is probably a shift into that privately owned space into the less mature business space. I don't need to go through all the different divisions of Macquarie, but I assume most people on the call are aware more broadly of us as an organisation and what we do. Really long history in sort of institutional seed capital through to kind of listing, IPO, M&A advisory, and that we think that's been successful. And now we're certainly pushing, and we have approved policy which we're trying to let the market know about as it relates to sort of the private under $50 million turnover space for IT consultants, SaaS and software businesses, managed service providers. So will be great now to respond to some of the queries, and whether some that have been sent through prior we can talk to, or certainly it would be great to be as interactive as possible through the hour if thoughts or questions do come up.
Yeah, perfect. Thanks for that, Harley. And yes, everybody, if a question does pop in that we're not addressing, please feel free to pop that into the chat there, and I'll try and be mindful of it and raise that question as part of this conversation. So, I mean, what's really interesting, Harley, and we touched on this when we had an earlier session, you and I, and we were talking about the different stages of obviously a startup, and then the growth stage and the various other things. And accessing capital is one of those things that founders really, really need to have across their mindset and realise what type of funding is out there, and when the different stages of their growth might be more conducive to see different types of funding. So looking at Macquarie, I mean, how would you assess the financial needs of your startup or the growth stage of your legal tech? If one was going to be starting the journey and perhaps considering a bank as an option, and then as part of all of this question, which I think we did last time and we got into a lovely conversation about it, we'll also touch on the difference between debt versus equity, because I think these two questions kind of intrinsically entwine into one another, And obviously at a very early seed stage, one would be looking at a different type of funding model perhaps. And then once we get proof of product, proof of concept, we'll be looking at something that's a little bit perhaps more into Macquarie's space. So I'll hand over to you to perhaps elaborate on that a little bit further, please, Harley.
Thanks, Kathy. When we surveyed the market, and this came out in 2021, so obviously there's been kind of a lot of things happening since that time. But we had, look, it was the first one. So it was about 130 companies responded in full to that. When queried about their challenges, 27% said accessing capital for growth was their top challenge. Also in that questionnaire was when asked about growth, where we looking to facilitate that growth. So 55% of respondents said that they were seeking to attract private investors, and 27% said that they were seeking to access debt, borrowings from bank. So I guess out of that came a couple of thoughts. So A, did people not know that they could come to a bank to borrow for an early stage technology company? And B, there are benefits of the two that the one offers and the other doesn't. So I think it is pertinent to start with a conversation around the difference between debt and equity, just so everybody has a view for, I guess, the balance sheets, where that comes from. I guess starting with bank debt, we have a benefit in terms of a cheap cost of capital, and that is effectively, people's money that is in the bank. So it is a good thing, I believe, that we've got a really rigorous regulatory framework on what banks can do with that money, because obviously everybody wants to get their money back at some point in time, and it needs to be really safe. So that's, I guess, been good for the Australian financial sector and how we've got through GFCs and pandemics and stuff like that. Naturally, though, it will create some challenges around, accessing that because you need to have de-risked yourself as a borrower in some capacity. And I think there's certainly an area in the Australian banking landscape to facilitate, small and medium businesses in borrowing, rather than what's been, the driver of kind of banks' activity for a long period of time, which is effectively mortgages, right? So we're trying to sort of come up with ways where there can be an avenue for business owners to help access capital for growth through bank lending. So I guess in one sense, you've got probably a lower cost to access that capital from a bank, but more rigorous testing in terms of how to access it. On the flip side, there are other providers of growth capital, primarily through venture capital and private equity. And I guess where the difference comes about, and I might just show a graph shortly to help visualize that, is that as a bank, we can't be seen taking speculative type investments in businesses. So it's got to be fairly safe, and the borrower needs to be able to show that they can meet interest repayments and ultimately repay that debt out of free cash flow or additional principal repayments. The private equity story is a different one, right? The private equity are more interested in going, well, we want to deploy our money into businesses that we can see a really good growth upside story in, and they have hurdles of returns that are obviously much more than traditional banks like ourselves, because theirs is aligned to the risk profile of what they're doing. So it might help quickly just to show sort of how we place this as it relates to startup businesses. So we sort of see seed capital, usually founders. Then you hit a period of time after some trading where it might be venture capital, private equity. And then at the point in time where the product is somewhat commercialised and can demonstrate free cash flow, there's an opportunity for us as a bank to come and start lending. And then, we all know the sort of hockey stick effect that software and SaaS businesses can have. So that might sort of help show the kind of getting over positive cash flow point of view. And then hopefully we are expecting to be the first bank that can provide that option at a point in time. But I guess
I think that really, sorry, that graph is really quite, illustrative there, because you can see at the earlier path, at the very, very beginning of the journey, That's not something where, you know, someone's going to say, I've got a great idea, I'm going to go to Macquarie, here, I've got an idea, and Macquarie's going to say, yep, I'm going to lend on this idea. Obviously, there has to be some sort of proof of concept. So, and it's the little picture there of a seed, and I was reading a piece on, you know, different types of investment, and the seed is literally, you have an idea, you get some funding, you sort of plant a seed and you see where it's going to go.
Yes.
And there's no real banking product that is, obviously, as you said, with the risk profiles and the rigorous structure of banking in Australia, there doesn't seem to be any banking product that one could go to as a founder at that stage that would be available. Is that correct? That's what effectively you're saying, that we need to get to a point where we are proof of product and we've got some sort of a second stage, be it maybe a Series A or a raise just before a Series A, where there's some more continuity and, you know, ARR, annual recurring revenue, or some way that we can tell that story. Is that what you're saying there, Harley?
Yeah, I think that's accurate, Kathy. You know, we are, you know, APRA is the main regulator for us, and effectively everyone needs to be able to demonstrate that there's money available to meet repayments if required. Now, we've got some flexibility around, has money been spent on a one-off dashboard development cost, right, that won't come again? Has there been some money used for growth that maybe didn't work out as planned, but effectively that was a discretionary expenditure out of the business? You know, if there was moving forward, that doesn't necessarily have to be incurred. So there is some flexibility around that, but all in all, yeah, it does need to be at a point where market's been tested, it's kind of penetrated, and you've got some track record of operating and selling your product or selling your service at you know, positive margins.
Yeah. So basically, as a founder, what you really need to be aware of is what I'm hearing from you is I really need to understand the financial story of my business. I really need to understand where it's sitting, where it might play, and perhaps I really should be doing some serious modelling based on various assumptions to look at where I'm sitting now, what those things were. So if there was a big CapEx cost early on that's now dissipated or moved into an OPEX, I can then look at it and say, well, that's something that is more an operational ongoing cost, but, you know, where we spent all of that in the initial startup, like say we were writing a platform. And so we threw a lot of money at something for, you know, 12, 24 month period, but now it's moved from build to, you know, ongoing operational improvement type costing, and then that can be looked at in a very different way. Is that the sort of financial product or the information you would want from a founder, as well as obviously the story behind it?
Absolutely, Kathy, and I think that there's a question further on around, you know, the rigor behind some of that financial presentation, and, you know, it pains me so many times when you see, you know, great products, founders are on the right path, it's getting traction, and the inability to be able to generate really concise financials and modeling of forecasts comes out, because it's not, you know, it's not the skill set, right, of a technology business founder. But, you know, if there is one thing that I could, you know, try and implore to the audience today, is that it's the value of investing in your financial advisors, your even just your financial reporting that you might be able to get out of whatever software you use. This can be really, really advantageous to either speaking to a bank or speaking to another form of investor, because everybody's going to sit back and make those assumptions, and everybody's going to want to know what levers can be pulled. You know, no business model turns out to be linear in its development. There's always going to be some volatility along the way. So, you know, and we've got examples like that. It doesn't just have to be in sort of a, you know, a one-person startup company. You know, some of the largest organisations that we've dealt with have had the same issue with them. PEXA is an interesting one. I don't know, most people would be aware of PEXA, but that was Macquarie Bank invested in PEXA early. we actually had Marcus Price, who was, I think he was sort of employee number 6 or something, and he became the CEO when they actually listed. But he presented to us and told a great story that I sometimes think about, which was that I went out, all the big law firms, all the big conveyancing organisations said, "Yep, this would be great. We'll digitise property settlements. Yep, you've sold us. Go and build it." We built it. Came back. He said, "Right,
I wanted to use it.
We're ready to go." And everyone said, "Who else is on it?" And then he sort of said, "Yeah, but it's what you asked for. We can sign you up." And they went, "Oh, let's just see whether it's working first and whether the market catches." Now, obviously it has worked, right? It's a multi-billion-dollar, digital infrastructure organisation. But even at that scale, there's going to be, some blips in the road as it relates to getting clients on board and things. I mean, right now we've got a huge spikes in cost of employees and people with technology expertise. So probably that modelling assumption that was done at the start to say, here's where our cash flow is going to be, here's where we need to raise X amount of money so that we can see through that time, that's probably changed again. So the ability to be able to kind of share that and at least come up with options to deal with those items when they come up is going to be really beneficial when talking to either a bank or talking to another investor.
And it's interesting that you mentioned PEXA because, and sorry, I'm not like plugging what I do, but that's what Logix actually does, is it's a conduit through to PEXA. And I know that what PEXA did, they came up with a $43 million solution, which was creating PEXA Direct Specialists. So, it was a big spend on a solution to get that conversion, and that together with some mandating. But, obviously their story has been a success story. And I think the real thing that I actually found, like myself personally, when I was going on a funding journey and with the modelling that we were talking about, was and we do have a question that someone asked is it worth going through all of this process? It takes a lot of time, costs a lot of money, and is it something that we really should be doing? And I know for myself personally, as part of our journey, going through the modelling and the assumptions was pretty critical as a founder to actually make you focus really clearly on your business and really try to understand your business. Because I think what happens with founders is that we start with an idea, or we get this idea, we test it a bit, and we say, right, this is solving this issue in the marketplace, and I think there's some real legs and traction and whatever on that. We talk to families and friends, we get that seed funding, we go on the journey. And as you said, along the journey, you go, oh, something happens here, I wasn't really prepared for this, but you overcome that and you move along and you keep building. But every so often, it's so critical to sort of take that step back and actually look at the business you've created, because you might think you're going on a journey this way, but it's actually taken a little bit of a detour and it's maybe going that way. And that might be where the market's telling you there is that pain point that you might be thinking it's over here, but it's there. And the reason I'm sort of asking a very long-winded question is that by doing those assumptions and by doing that modelling and working with your advisors, then you can start to understand the nature of your business. So you might say, okay, I'm not quite at that magic target. And I know you and I discussed this earlier, and I was told it was 2 million, and I know that you've got a different figure, which I will ask you to talk about in this answer. But, until you hit that, you might be saying, well, there's no point going to Macquarie. It might be that I need to go to private equity, or I need to get venture capitalists involved. But as you said, that type of funding comes with different parameters as well that might sort of hinder the next phase of your journey. Whereas the debt funding might be something that, even though you're committed to making your repayment, you perhaps get more freedom in your operation. So I think in a very long sort of winded question, would you say that the sorts of things in doing our modelling, what are the things that we should be including in that? Would someone like Macquarie be interested in someone who, or a startup that is past sort of proof of concept but isn't quite hitting the targets on the revenue? And are there opportunities within Macquarie and that to partner up or somehow work together with those founders to lift them up through that next part of their journey?
Well, yeah, look, short answer is yes. And I would have to say it. Founders are passionate, they believe in something. They've identified this gap in the market from their experience, and they're trying to solve for that for a whole heap of customers who aren't necessarily there yet. And that's awesome, right? Everyone loves the sort of entrepreneurial spirit of that. But I guess there's often going to be different personalities. So, myself, Adib, we kind of have to work with numbers in a way. And, there's many different, I suppose, exposures that we have to deal with that. So I guess that's why the modelling can help so much. Not to mention, obviously, there's so much, there's probably investment of money, there's heaps of sweat equity that's gone into it, time, all this to that point. So there's still plenty at stake to make sure that whatever counterparties you're dealing with to get through the journey are satisfied in what you're saying. And I think having that a buffer there is really important too, because the times where a bank basically might say, well, give us your home as security, you can kind of write a check because we're secured, are gone. And they won't be coming back. And we, Dib and I can talk to experience here that is, I guess, given it's mainly regulatory driven, but, think about what we sometimes call the sort of a current affair risk as well. It's not the case that if something doesn't quite work out, you run out of money, that you can just say, well, look, bank, can I borrow against my house? It needs to be presented in a much more sophisticated way in this day and age, following Royal Commissions and following GFCs and things like that. So that's probably something I would really want to get across to the audience as well. So, coming and having those conversations to whichever capital provider you are, it's not great having no liquidity and really needing that investment, because you lose a lot of leverage. So it is better to be able to say, based on these assumptions, we're foreseeing a little bit of a cash flow drain based on some dev spend we've got, or based on some staffing up that we need to do over the next 6 to 12 month period. Can we start talking about solving for that solution now? And yeah, absolutely. We would love to. We'd love to be involved in those conversations, even if it's not at a point where we can provide debt, but to be able to sort of talk to some experience and to kind of help leverage some of the, the workings we do internally. We're probably not, there to do a full report or an analysis on the business. That might be, accounting or consulting groups to deal with at that point. Which again, I would recommend kind of investing some money in at the start to get their views on things. But yeah, I think to answer your question, Kathy, more than happy to talk through some of those, because it doesn't necessarily come naturally.
Yeah, and I'm really, really glad to hear that you're not going to take funding out on my house. Like very early on in my journey, we met with a venture capitalist who said, well, how do I know you're going to still be here? What sort of properties do you have? Blah blah blah. And I was actually quite offended by that, because I said, well, I believe I'm going to work really hard on this, and I'm going to build this vision, and you're going to get my blood and guts and everything, and on top of it, you're going to come along for the ride. I'm telling you about the risks and the upscale, and I've thought about all of this, but I don't want to be losing my home either. So I do think that that's a really important thing, but I also understand that, the lender as well, we've heard many tales of founders who have come along and, they talk about all of these things. I mean, Elizabeth Holmes really sort of pops into everybody's head on that one, and they're building these things, and people put in all this money, and, they've run off into the wobbly yonder. So it needs to be a balancing, I suspect. And I think also understanding your story is really important, understanding your market perhaps, and understanding to explain where there might be some risk. So for example, the PEXA story is a really great one, and I, as I said, I relate to that because I'm in a sort of very similar position in that people say, yeah, great idea, and then you go there and they're like, oh, we're not quite ready to change, we're not quite ready, because it will involve a change in their process internally. And eventually, that will happen, but the lag time might be longer than your original projection. So, and the only reason I'm mentioning this is because someone else who has an idea or a platform might find that the uptake isn't as quick as they thought, or then something might come along, like look at Zoom before COVID, and then all of a sudden COVID happened and Zoom, I mean, everybody was using it before, people were using it, but now everybody uses it. So,
And you raise a good point, Kathy, for what Adib and I would deal with internally. The banks are split between your sort of industry expertise and frontline client-facing groups, and then risk, right, which sits behind. Yep. Now, when we put a proposal up to lend money, we just got to do a downside scenario, right? I don't know whether it's necessarily that pertinent, but it just is what it is. I think all lenders will want to see the same, and it might be interesting for the audience to know that our internal risk people hate a blue sky sales scenario, right? They're like, great, I want to know what happens if things don't go to plan, what this business owner will do or what this organisation will be able to do. So I think
how they'll pivot or
how they pivot.
Yep.
Is there a regulatory issue that they think they've mitigated? I mean, like, I look at Afterpay like that. And Afterpay, obviously one of the arguably the most successful tech business that we've had out of Australia. And they basically had their way to get around the consumer credit lending legislation. So where there was a lot of people saying, I don't think this level will work because it'll get captured as a bank as it gets bigger. It didn't, because it had the way they charged a fee was different. I think that those sorts of identification of risk and then how you've mitigated that risk is important to get across as well. And it's something we have to be aware of as well when we're trying to, formalise a lending relationship with a tech company. What could go wrong and why do we think it's not going to go wrong? It's just an important kind of two sides of the coin to make sure you have covered when dealing with all the relevant counterparties.
So in your experience then, just listening to what you're saying, are you finding that, because obviously founders are a very unique personality. So founders are very much kind of blue sky people. I think they wouldn't go on this crazy journey if they weren't. Someone who says, oh, I've got an idea and I'm going to actualise it is a very unique, specific individual. And, and so I've read a lot of books about very different, founders, like from Clarence Birdseye, who was up in Alaska, freezing all these things, and people didn't even have fridges, to, Phil Knight, who with Nike and, running debt and sort of credit and all of those sorts of things for 15, 20 years. And they all, but one of the things they all have is that dogged belief in the vision and actualising it. And perhaps along the way, modifying it a little bit and tweaking it and listening to the market. But I think when you start to put them together with whoever is funding that, there needs to be that collaboration. And what are the things that you would look at with a founder? How can I put it? A founder that just walked in and it was all blue sky and everything was starry and there was no prospect of anything ever going wrong, I think would raise red flags, I suppose, immediately to you as a lender, as opposed to one who perhaps is, still blue sky and is still selling a great story, but is saying, look, I am aware of that. These are the things that I think will mitigate that, or these are the things that might impact on that, or how you read it might not be quite correct because of X, Y, and Z, like Afterpay, for example. So Are they the sorts of things you look at in assessing, like not just a paper thing? Is the founder themselves a critical aspect of your assessment?
Yes, absolutely. I mean, you probably argue it's the number one, really, like the sort of person behind. And then I think the demonstration of that level of thought and that sort of business acumen, I think, puts the best foot forward in terms of getting the best deal, whether it be with a bank or an investor, or VC or private equity. It doesn't always come naturally, but it's definitely a good investment of time to have that, because ultimately, it might go through the various stages of an approval. And then if you've got other people coming up with these issues that have got no way of addressing within the business, then, it can kind of become, a lot of steps and back and forth and a much more painful experience. And it's, sometimes kind of, when you've got other people kind of identifying things that could go wrong, and then on the spot trying to think of ways of how it could potentially be solved. Then that's or if you've gone into business, if you're a founder and you have said, right, I'm going to invest this much money, this much time, and quit my job, and you haven't kind of thought about a competitor, or you can't price below a competitor, or you've got a regulatory issue that you've got to pass before you can actually break into market. Those things are obviously a huge red flag, and it would go to the individual that is effectively running the business and making decisions on a day-to-day basis.
Yeah, and then just looking at, like, as I said, I mentioned that when I was going around and looking at a growth funding, or our second raise, people were sort of saying to me, your real key target is that $2 million mark, and is there a magic figure that, say, Macquarie would look at as the annual recurring revenue, or is it dependent, is there a cutoff, or are there other factors that you might look at that might, Macquarie might say, no, well, it's not quite 2, it's a bit more. However, we might consider you if you were a little bit under, and what are those sorts of things? What's the hard and fast rule, or kind of rule of thumb?
I think that's an interesting question, and I think there's probably 2 ways to kind of approach that, because again, a bank versus the PE or VC might look at this differently. I don't think that there is necessarily a cut-off amount or level of revenue to hit to then make you bankable. I think that personally, I would rather be banking a business that has just made $500,000 of revenue quite quickly because they've got a product that solves a key problem. It's profitable. Market has taken it up quickly. Versus there might be a business that is doing $3 million of revenue, but they've got that through sort of 2 clients, and they've just had to tailor it for them, right? Or a business that's gone, right, we're going to be spending a lot of money to try and get people out in market, and they can't sell it for a price that's profitable, for example. So I think there's a few different elements that come into that. But I think you do need some revenue for any investor, because, well, other than kind of seed, because otherwise, how do you know if your product or your service is going to actually be attractive to your target market?
And also working out what type of revenue. So for example, whether or not it's that ARR licensing type fee, or whether, for example, Logix is transactional. So it means that, our throughput is based on volume of transactions that we get through. So, and there are different sorts of funding and revenue streams, and obviously as a banker you would be looking at, okay, well, how good is, and PEX is a transactional one as well. So, you look at that, and you look at, say, other ones that then, there's a licensing fee, they've signed up A, B, C, and they have X number of users, and so they'll be more, I suppose their income is more predictable than, say, transactional, depending on who the transactor is.
Correct.
And do you look at those sorts of things as well?
We do, and we see it in multiples that market will pay, which wouldn't come as a surprise to anyone on the call. But the more recurring in nature your business, the more valuable it is, the more saleable it is, because it's not reliant necessarily on people within the organisation. So that then attracts investment and lending. I think if we're going to sort of cut that down between the two styles of capital to attract, the bank is to know that there's going to be money each month to make the repayments, right? Are you going to be ahead in terms of cash flow? The investor story is growth, right? So is there going, right, how big is this market that we can get into over a certain period of time? If it's recurring revenue, how many adjacent services can we bolt onto that into the future? And we're happy to fund that and churn through and burn that money each month to make sure that we're getting that real growth story and scale. Having said all that, we do have $4 million is basically our threshold. It's not black and white. That's kind of the guideline as to where we think we can provide bank debt. And that is probably by the fact that to borrow money at general margins of a business that's commercialised its product, you sort of need to be at that end at that level to be able to kind of pay off your debt and service it with some buffer, in an immediate period of time. But there's a lot more to delve into in terms of the customer value proposition of the product, I think, than just purely what revenue runs are on the board within a certain period of time.
Harley.
Sorry,
Kathy. It's Stu here. Sorry to interrupt. I'm just keen, as you sort of talking through this. I think there's a lot of maybe a sort of a negative slant towards sort of all the challenges around raising the capital and so the reasons why the bank might sort of scrutinise the process. I'm keen to understand why someone would. Right. I mean, there's a lot of avenues for raising capital now, and raising debt capital is sort of something that isn't actually in fashion, I guess, as an overall statement. So why does someone? Is it about speed? Is it about not needing to relinquish more control of the business? What are the main reasons why someone would turn to debt capital as opposed to the other 10, 15 ways of raising capital?
You're right, Joe. And I think that it has been. It's been the non-dilutive aspect, right? So if you're raising through notes or you're raising equity, obviously your share is reducing, and that hasn't been a problem because technology companies and technology as a sector has been so ferociously in demand that values have kept going up. So it's been a good move. I think the bank probably provides you a bit more. I'm not saying one is better than the other. I think there is a time and place definitely for both. I think where some of our clients would prefer to bank, we're less involved, right? We're not at board meetings. There's covenants to hit. You've basically got the money for 5 years as long as you meet your payments. If something goes wrong, like the strategy doesn't get hit, it's not as though there's a tough conversation to sit there and go, right, how are we gonna rectify this, and this is your amount of time that you need to do it. I can say now that no banks really are that keen to wind up businesses all that quickly either. There's definitely a lot of lead room before that happens. So I think that probably the lack of influence on your control, A, within your equity share, and B, within the day-to-day management, has probably been the attraction of banks. Now, on the negative, we probably don't bring a lot of expertise or experience to the table to help you grow your business or give you ideas. So that would be another positive of why a lot of business owners have preferred to go down the private equity or VC road.
And I guess some companies, a lot of companies that are coming to you have already, as we've discussed, gone through different cap raise series and events. So debt capital is just another element of raising that they've got on their plate. And so I suppose, getting a clear understanding that they're coming to you at a fairly mature, I would say, sort of that scale up stage as opposed to the startup stage, which makes sense. And I guess for those, sorry, yeah, got a comment on that?
No, you're absolutely right, Stuart. And I was going to say that the number of raisings, it's been enormous, right? 700 odd raises in 2021. It's $10 billion, threefold increase of what it was the previous year. There's actually been more participants in those raises than there were actual raises, which means that a lot of occasions you're getting a couple of VC companies involved at the same time. That's kind of that could be a good thing as well, because it's much more prescriptive as to ongoing management and expectations, and obviously bring a lot more skill sets to the table. Yep. But one thing that may impact moving forward too, Stuart, we've got to think about what cost of capital has been to investors lately, which is basically zero, right? When we're effectively been at free money since we went to 0.1, right? And that's been globally. So that has probably made the terms lucrative, because if you're looking at who has actually contributed money to these funds, they're not really losing out anywhere else. They're happy to say, right, let's just see how this works out for the medium terms over a few years, because that makes sense in the investment. That may change moving forward, which could make a differential on price or on terms, because as we start to have a look at, discounted cash flow valuations and opportunity cost of investment. It will change
Makes sense.
as rates move up.
And I think this leads to a really good segue into the next part of this sort of funding issue is the exit, the longer term exit succession. You just mentioned, Harley, that if someone obviously has got past that seed and is much more established, and then they say, right, we don't want to relinquish more control, we'll come to Macquarie or someone like you, and we'll look at some debt funding. And then you said, well, you're there for 5 years. So at the end of that 5 years that you've just mentioned, at what point then is Macquarie then sort of saying, great, write us a check for the balance of it, or we're moving you to a point where you go to an IPO or some sort of an exit for us to get our funding back, because we've helped you along the journey now. And if you've gone all through these projections, you should now be at a point where you are either a saleable or an out, or there's an exit, or just write us a check.
Yeah. Generally speaking, in that 5 years, I suppose as banks are all annuity businesses, right? So you really, once you've got clients, I know certainly not, the industry's certainly not perfect, but, once you've got clients, generally try to keep them, and then provided that performance and expectations around covenants and, your account conduct and things have all been satisfactory, then it will just roll on again and sort of assess whatever terms are relevant at that expiry time and the renewal. I know us as a bank, it then comes down to a point, and that might be 5 years, but there will be a life cycle of the company, and whether that is an exit for the founder, and how that can be structured, which I think that's kind of one of three ways. There's sort of the internal, there's trade sale, or there's an initial public offering. So, internal, very professional services orientated. It's quite popular where where there's a business model of a lot of people internally contributing to the revenue. But it's kind of getting interesting now. I think we're going down a bit more of the American model and giving equity away to staff as a remuneration structure, which we think is a good idea at Macquarie. Trade sales, I think can be great. So you think of the classic, the big fish trying to acquire and buy good businesses that are much less risky, which often then would coincide with us having been a lender to that business. But there's a big market for these bigger, either private equity owned, listed, and these people on these boards, are under constant pressure to grow. Like they've got to grow, and often they do that by identifying good businesses at an earlier age or earlier stage of their growth cycle, attract good multiples, be cognizant of what sort of kind of terms of your cash versus script and how many years you're in escrow. One of the I suppose the piece of feedback that we get, and this isn't just in technology, into the technology sector, it's across the board, is that often that means what do you do then? You're done, you're sold. It can kind of be the end of the journey in a way, which a lot of people don't like. And then there's the listing, which can be different because often those founders then stay in the business. They're on, board of directors, and they can kind of keep that growth trajectory going with different investors. And it obviously opens you up to the biggest pool of capital that is possible by going down that path. But there are a lot of negatives with IPOing as well, I probably would say. I don't think you want to IPO as a small cap necessarily, because you've got a lot of that, regulatory and reporting environment. We had that experience with Nuix, I guess, where good product, but maybe some issues previously amongst individuals involved, which all went public. So that's probably the other consideration to have. All of which, they're generally great results, but weigh up pros and cons, because it is always good to have sort of a journey and an end goal that you want to hit and target, and have a longer term plan as founders.
I think that really captures the essence of it. And look, you know, the overall conversation and what I'm getting out of this this session today, Harley, is that really, as a founder, when you're first starting off, obviously it's probably your friends and family, or you bootstrap it, you know, if you've got a really good idea. And then as you find along the journey, and it could be that it's that 6-month thing, you know, that you suddenly have $500,000 and you've got 100 clients that have all signed up, and you know, people are talking about it, and all of a sudden you're about to go boom. And that might be something at that point where, even though Macquarie would not be someone to talk to actually invest, perhaps you might want to know, or put that business on your radar, or maybe it might be one that you start saying, well, look, let's pay a bit of interest in this and keep talking to us, founder, and whatever. We're not going to put money today, but in a year or two, if this is still happening, that might be something that we're interested in. And you know, it sounds to me that in that in-between phase is where, you know, we either keep going back to friends, family, private equity, venture capitalists, and start to look at, you know, pairing off a bit of sweat equity if we need it, if we're not getting enough on that cash flow on the build to give us that revenue. And just one other question, so like, and you can just let me know if that's what you agree with, but when you were talking about, say we get to a point where we are at revenue of, you know, 3.5 mil, we're not quite at that 4 mil, and we're not actually wiping our face either with that revenue, we're pretty close to it. Does Macquarie need us to be like break even, wiping our face, showing a profit, or is that revenue showing that there are, obviously the product is a viable product for the market, and the market, there's an appetite for it, but the build or the running has been such that we're still not at that break even point, although we're coming in with this sort of revenue? Is that something that is really important as well?
Look, I think, Kathy, you know, at the, you know, to avoid any risk of, you know, setting the wrong expectations, in general, yes, like we would need to have seen some level of profitability. Now, we can make adjustments if that story can be explained, and we absolutely have done that. I think, and look, it might be, you know, an interesting kind of segue for a dip to speak just quickly on his journey, because we're not going to be able to solve the capital requirement for every business or everybody on the call. I'm sure, you know, we would love to have some dialogue with a lot of businesses as they are growing and moving forward. But I think what we do know is that we've taken a view that technology is the third biggest sector in the Australian economy. We anticipate 1 million people employed by 2025 through technology. We think that Australia has produced some exceptional technology entrepreneurs and businesses and products and software, and it's probably on a better trajectory of actually kind of breaking into enterprise style markets that overseas companies might have, you know, had the wood on us in some capacity, or we haven't kind of gone into overseas, or very few companies have gone to the overseas market. So we think there's some really good upside. So we wanted to, you know, identify the gap that was in the market for privately owned small and medium-sized enterprises to access bank funding, because there's a value to the companies and there's good thematics for firms moving forward. And you know, as it relates to legal technology, it's absolutely right to welcome, you know, some more efficient ways of doing the various services that the law industry provides, and we know that that's been a fact. It's you know, we're exposed to kind of, you know, prop tech as well and insure tech. There's definitely synergies there. We're to say, like, the traditional model of paying an hourly rate doesn't necessarily have to be the best way moving forward, and consumers will agree with that. So as far as we know, though, we're the only major bank with an actual credit policy to lend against the balance sheet of small and medium enterprise technology businesses. And that's probably where, you know, where a dip joined us recently, trying to do the same thing at NAB, and just not being able to get with any sort of consistency debt finance done for smaller businesses.
So maybe can you tell us a little bit,
Hi.
Can you tell us a little bit about your journey and
Yeah, definitely.
what you're hoping to achieve there at Macquarie?
Yeah, definitely. Great to be here and to meet you all, and hopefully in person soon. Look, it's been fantastic to join Macquarie, as I've been passionate about tech for a while. As we know, it's high, fast growing, industry, and also I think it's the way of the future. I think the way everything is digitalized, you don't have to look hard. Because some of the traditional businesses will be changed into something more technology based, and that's subsectors in it, like prop tech, law, legal tech, but ultimately the technology enablement underneath that is really what's going to be the way of the future. So now I've come from NAB, which is a bigger bank, and I mean, in short, Macquarie, has got a proposition now to lend against the goodwill and the cash flow of the business.
Yeah.
Which is probably a 5-year head start, in my opinion, compared to the big 4 banks. Now, I can only speak for NAB, but I can almost, see that NAB, ANZ, Westpac, they're not that much different, right? NAB has the biggest business bank book. So that was the reason why I wanted to join Macquarie, because I'm passionate about the industry and the community. But also I've done some work in the past at NAB, and the discussions around traditional, like bank funding and, the equity market, the VC&P. Ultimately, I think the ultimate objective myself is to provide, to be a banking partner for startup businesses in Australia, and we want to be tech friendly, and we want to assist technology business to be bank ready, which is the key word there. And how that looks like is dynamic, I think. Did Macquarie have this proposition 2 years ago? No. Will we have more in the next 2 years? Possibly. And do we want to talk banking to technology companies? Yes. So the door is open for us to chat. There are metrics that we can lend to now, but it's something that we can work around. I mean, Kathy spoke about revenue. There's so many ways to look at it. We can have a 12-month rolling revenue, which, we look at run rate. And I think it just goes to show that we want to be able to show that we understand your industry more. It's not as straightforward, it's not linear, and it's not traditional.
Yeah.
So, but yeah, other than that,
different.
It's different.
Just a different option, and I think that will, hopefully can come across to some of the viewers and some of the members at ALTA.
Yeah, and like Yvonne here has just posted that we'd love to see what the bank matrix for startup funding is, and my sort of takeaway from this discussion is probably startup isn't quite where we would need to be going to the bank, but at some point along that way, and it might be that $4 million mark, might be just short of it. It might be that we've got that $500,000, but we're really got a great trajectory, and perhaps the information is understanding who we are as the founder, so that you can put something further up the line to say, look, I've met with Kathy, or I've met with whoever, and they've got a history of businesses, they've done this, they've done that, they're really across all of the different things that they've brought us the modelling, they're talking about where they could go, but they're aware of risks, they're aware of what they might need. This amount will be runway, this amount will be put here, etc., etc. Are they the sorts of things that would make a really great proposition for Macquarie to actually start that conversation?
But absolutely, yeah, we'd love to have that conversation. And it might be a case, we might have to be honest and say it is too early for us to be involved, but here's an opportunity. If you're talking to a private equity or a venture capital firm, they're a bit more flexible with the styles of deals they can do, right? So I talk from experience, some might have convertible notes, right? So that they've got 2 years before they convert to equity. Some might have capitalizing debt, right? Which just goes at 12%. And, you owe whoever is there. Some might say, well, we've got our emerging fund. We could tap into some of that money at, and they will take a share of equity based on how we want to value the firm at that point in time. And that might open a lot of other doors. If you're really trying to grow, then you might say, well, I'd rather have 20% of my business owned by, I don't know, Square Peg, right?
Yep.
that then goes, oh, well, they might be able to make some introductions or give me some advice on other businesses that they've seen, because
and then it might be that after that, in 2 years, where you then do have that cash flow, you then say, right, we're on the next phase, and then you go up to Macquarie and say, right, like, we've done this is where we are. Are you, is this something that you would want to then have the appetite to sort of help us or give us some extra cash or whatever on it?
And Kathy, probably the most common transaction that we've had over the last 2 years, well, over the last couple of years, is exactly that conversation. A business owner says, look, I wasn't profitable. I borrowed money from whatever source. Based on the value of my business, that investment has now tripled their money. They're happy to get out because I'm a little bit too safe for them moving forward. Macquarie, would you be happy to lend, whatever amount that payout figure would be to us as a debt? And then everybody's happy. VCs get their good return. Founders have got a de-risked business and they've had good advice on the way in those early stages, and then they can keep the rest of their equity.
Really good takeaway, because I hadn't actually thought of that before you just mentioned that. So it could be that you go on your startup journey, you get your seed, then you get maybe you look at a VC or a PE, in that in between. You then hit certain targets and you want them out, or they might be pushing you to go a certain path, and then you can come up to Macquarie and say, look, we're now at this. This is where we were. This is what we've done. Can you come in, take over, and then and then what we're thinking is we're going to do this because this is where we ultimately want to get to with our journey, And so in that, there's just one little point on that. Obviously, then Macquarie would look at the sign-ups and the deals that you might have done with the VC and the PE for, like your drag and tag and any other sorts of things like that. Is that right? Like they'll be the little tricks that perhaps founders may not be across at the time that they've taken that cash on that step before.
Yeah, exactly right. Yeah.
Another food for thought is that in terms of being bank ready or have that early engagement is the transactional banking. When you raise capital, you do the deposits with us. We've just launched a fantastic banking platform called Macquarie Business Online. So that could be a very constructive way to build a relationship with us. Because then we can actually see the capital raises firsthand, the account conduct history, and when that transitions to debt discussion, it's probably more natural once you bank with us. So that's just another venue of early engagement, which is via transactional banking.
Yeah. All right. Look, I think we've pretty much answered everything that was there on the questions. Was there anything more either of you wanted to tell our members? I've actually found this a great conversation, but if there's anything else that you wanted to add?
There's not, but would love to reach out to a lot of people who are joining today. Sort of make the connections, and feel free to reach out if there was anything that subsequently comes to your mind. But I think the thoughts we wanted to leave the group with today was that there's different probably ideal targets to assist across the various journey of the startup. Hopefully there's some advice or some tips of where to make sure you're investing some money through that stage, and it might hopefully help to guide some of the framework that banks operate under. But you're in a fantastic spot at the moment, insatiable demand to invest in the digitization of the economy. It's been just sped up so quickly through COVID, which is great, and it's a trend that, as we said, Macquarie Bank's certainly in agreement with, in terms of opportunities for yourselves to capitalise on moving forward. So
yeah, and look, I just want to say this has been just a very uplifting conversation for me as well. In that you've opened my eyes, at least, sort of saying, well, you know what, just because we might do funding at this point X, that doesn't necessarily mean to be where we want to get to and what might drive us to get somewhere along. And so as founders, I think we need to be really, really across our financials. I think we really need to be investigating our business and really understanding where it is and reading the market and challenging our assumptions constantly. And then in terms of negotiating with different funders along the way, we need to have perhaps our eyes thinking a little bit further ahead as to where our journey might be, and, you know, whether it is that ultimately we go to debt funding or we go to IPO, whatever it is that would suit our particular business. But look, thanks so much.
And Kathy, one thing also, that you guys have got the power. There's negotiating power in your hands at the moment when talking to funders on an equity side, because there's demand there, there's number, and carry that with you. You know, make sure you're speaking to the people, you share a same purpose, you share that same vision, Kathy, that you spoke about, and that everybody, you know, there'll be a good partnership on that journey. I think that's something to be people to be aware of.
Thanks so much for that encouragement, because, you know, as founders, we sometimes get so bogged down in the doing that we forget that. So, look, I really have appreciated this, and it's been an absolute pleasure hosting you today for the member meetup. And thanks everyone for joining us.
Thanks everyone. Thanks, Kathy.
Thank you.
Bye.